All right, guys, we'll start the stream in a minute. There's just some people in the office, so I don't want to disturb them with the live streaming. So I will see you guys once we get downstairs. Busy day, lot to talk about. It's going good. Feeling good on this Monday. Can't complain. Let's just get off the elevator here. See Penelope, good to see everybody. Trust everybody had a beautiful Monday. We are just leaving the 200 Southeast Financial Center now. It was a beautiful day today in Miami, Florida. See Vinny Castellano, Abby, welcome. So really quick, right out these doors, they're gonna build a completely new plaza. So coming to downtown Miami in 2022, it's gonna be a pretty interesting space. Hopefully we'll be live streaming from there. Wow, all right. Happy Monday, everybody. It's good to see you. Welcome to the beautiful downtown Miami, outside of the 200 Southeast Financial Center. Now, we usually begin the streams in the office, but today there was a couple people there. I did not want to disturb them. So hopefully you all are well. Your week is off to a fantastic start. On tonight's live stream, it may be a little bit of a shorter live stream, maybe about an hour and a half. But today is very, very important because today is the first business day of the month. And you guys know what that means. That means the Institute for Supply Management released their Purchasing Managers Index, or the PMIs, for September. Now, we do have some bad news because the numbers didn't come in that well. The Institute for Supply Management PMI came in at about 50.9% in September. That is below the 52.3 estimate by economists. So if you remember last night on the Markets a Look Ahead live stream, one of the things we covered is the estimates for the PMI numbers. And consensus on Wall Street was for a 52 reading, which actually could have potentially, check out this cat, could have potentially started an additional uptrend in the PMIs or in the manufacturing sector. Hey, what's up, pal? Good to see you. Happy Monday. Oh, it doesn't like me. Hey. What's up? I won't harass him. He's scared. Good looking cat though. 10 out of 10 on the cat. Wish I had some food. Anyway, so we were talking about those PMI numbers, and economists on Wall Street, the consensus was for 52.3%. We came in well below that, right at 50.9. Now, August's reading was 52.8. So do you notice a trend here? And I've been sort of beating this like a dead horse for over the course of the past 6 months, that it's not so much the number that the PMIs come in, right? Because A reading above 50 or above, signals expansion in the manufacturing sector of the economy. And a reading below 50, oh, check out these two dogs here. A reading below 50 signals contraction. But if you've been watching the stream, that's really not the right way to look at the PMIs. The right way to look at the PMIs is the overall trajectory, or I would say the direction of those PMI numbers. And as of right now, pretty much ever since October of last year, we have been having deceleration in the PMI numbers. So what I did is I actually wrote down, I went back throughout the last 12-month history of the Institute for Supply Management PMI readings, and we're going to go through each reading, and you guys are going to start to see a trend here, because the PMIs are essentially a live look at the business cycle, and there's a very, very high correlation between the PMIs rolling over and the equity indices rolling over as well. But before we dive into that, my friends, let us say hello to all of our viewers in the chat. We have Qantas here, says, hey, good to see you. Vinny Castellano, Paul Greenwell, good to see you, Paul. Willette C says hello. Carson says, evening, Tom, good to see you, Carson. Welcome to downtown Miami. Beautiful night, by the way. It's probably about 77 degrees, very, very low humidity. I see 61 says, happy Monday, Tom. Great start to the week. Likewise, my friend Dusty Cole is here. Penelope is here. Wendy England, John QQ says hello. Joni QQ says hello, walks in Wall Street. Buff 20 says, hey, Tom and chat. RJ, good to see you. Says, hola, Tom from Colorado. Seaburger is here. Dan Zhang says, hey, Tom, how was your day? Day was pretty good. Busy day, though. Wasn't expecting it to be such a busy day, being that it's the first business day, not only of the month, but of the quarter, right? So we are now in a brand new, fresh quarter. Welcome everybody to Q4. So for those of you who are in sales, you probably have maybe a 1 or 2 week break before things start picking up again and before we start planning for the end of the year. So it's good to see everybody. Hey, the fly says, Tom, Carnival Cruises is under $7. Yeah, a lot of those cruise line stocks I would never ever touch. Now, a lot of the cruise line stocks were really wrapped up in a lot of that irrational exuberance that was going on during the COVID pandemic. Sparks Carnival says, Tesla made me sad. Yeah, I mean, I think we had a pretty big rip-roaring rally, I should say, on Wall Street today. We're going to talk about maybe why that happened. But I think Tesla was down pretty hard. I think Tesla was down like 5% today. But I think the more important thing, were you guys watching the movements in the bond market today? These are very, very unusual movements in the bond market. And we've sort of been following this dichotomy here, where anytime you have the yield on the 10-year US Treasury note or the bond moving lower or declining, as well as the Dixie or the dollar declining, you could pretty much bet with almost certainty that the equity market is going to rally. And this has been a pretty big move in that 10-year US Treasury yield, because just last week, I think in one of the overnight trading sessions, the yield on the US 10-year briefly for a little bit hit about 4%. I think as of today's close, the yield on the 10-year US Treasury is trading for about 3.609%. So that's a substantial move to have yields come down that far. If you remember last week, the Dixie got all the way up to 114. We are now sitting at, I think, 111. So pretty much what I do is, if you guys have a free TradingView account, I would definitely go online and create one. And I think the two main things you should have up there to sort of watch the mechanics of the market is just look at the entire yield curve in general, but mainly focus on that 10-year US Treasury, and you'll start to see a pattern here. It's not 100% of the time, but usually if you have that 10-year US Treasury yield moving lower, as well as the Dixie moving lower, you're probably going to get a decent bid in equities. Hey, Lena Sandoval is here. It says, hey, Tom, good to see you. Lena, thank you for being here. Hopefully your Monday is going fantastic. I see Susanna Herbert. Good to see you. I think we have something jumping out of the water here. I'll keep you guys posted. Buff 20 says oil goes down, Tesla goes down, oil goes up, Tesla goes up, says Buff 20. NYC Dubs says dead cat bounced today. So let's talk about a couple levels. I really wanted to do a deep dive on the Institute for Supply Management PMI numbers, which we will. But let's talk about some technical levels here and why we think that we saw this particular rally. Now, obviously, those are the two big reasons, right? That 10-year U.S. Treasury yield coming down, the dollar coming down. But from a technical perspective, I mean, this market has been almost literally a month straight of declines, soul-crushing declines. So if you throw a 50-day moving average up on the chart of the S&P 500, the NASDAQ, and the Dow Jones Industrial Average, I think across the board, we were extended about 10% to the downside from the 50-day. And that usually signals we're going to have some sort of a near-term bounce. Now, do I think this is a bottom or do I think this is a bear market rally? I think it's a bear market rally. And these rallies are very normal and very, very common in bear markets. You know, markets just don't go down in a straight line. They go up, they go down. And if you noticed, when we bottomed temporarily in June of 2022 in the summer, we had that big rally. You'll notice the key levels where the market started to roll over. And it started to roll over right at the 50-day moving average or the 200-day moving average. So I wrote down some of these levels here for us to look at. If you want to follow along yourselves, if you have a trading view account or something like that, it's a free charting software you could sign up for. It's very, very helpful to sort of decipher some of this stuff. But I believe the 50-day moving average on the S&P 500 right now is sitting right at that 4,000 level. If we look over to the Dow Jones Industrial Average, I think that 50-day moving average comes in at 31,800. And on the NASDAQ, you're looking at that big round number, 12,000 for the 50-day. So could this market roll over tomorrow? Yeah, it could, but you know, usually bear market rallies last a week or two, and we are significantly extended to the downside. I think all the major equity indices are at least 8 to 10% extended below their 50-day. So maybe you'll have a rally back to the moving averages and they'll be turned away. But what do you guys think? You guys think we're just going to roll over tomorrow? Do you think this is going to be more of a sustained bear market rally? Dubs says no bottom yet, maybe S&P around 3,400. Maybe. Unij says hello everybody, good to see you. Welcome Unij. Vonda Howard is here, says hey everybody, good to see you Vonda. Thank you for being here. Ernesto is here, good to see you, says yo, welcome man. We got a big traffic jam backed up here. Everybody seems to be upset. Hey, Andy is here from South Korea. Good to see you, Andy. Daniel Perez says no one wants Tesla automobiles. California wants to eliminate gas and gas automobiles permanently. Then California Governor Gavin Newsom. I don't know about that. I don't know about no one wants Tesla automobiles. But I respect the opinion. Susanna Herbert says hello, Tom, and good Monday to everybody. Thank you so much. Welcome. Trust you're well. Vinny, good to see you. Angel is here, says hi. So I wrote down a couple things I wanted to go over. But I think for now, let's move in between these cars here. We are here at the Epic Hotel. Very beautiful hotel here in downtown Miami, but I want to cross over the bridge to Brickell. Now, before I forget the Nightbot command, if you guys want to follow along during tonight's live stream and listen and just read along with this piece of very, very important economic data, if you type exclamation point PMI, so once again, exclamation point PMI in the chat, the Nightbot will drop the link to the September 2022 Institute for Supply Management Purchasing Managers Index, or the PMIs. And the reason why the PMI numbers are so important is because it literally gives you a live look into the business cycle almost, and into the health of the manufacturing sector in the United States. Now, later on this week, we are also going to be getting the services PMI. So assuming I could do a live stream, we'll do a deep dive into that as well. But this was a big miss. And consensus on Wall Street, so many of the economists believe that we would get a reading of about 52.3% for the September PMI, which would have actually been a little bit less than the August reading. However, economists missed that by a mile. The PMIs came in right at 50.9%, almost missing by 3 percentage points. So that's a big miss. Which is not a good sign, showing weakness in the manufacturing sector in the economy. Hey, Chris Beeman is here. Good to see you, Chris. YTTV says dollar more than euro. Yeah, and a lot of that dollar strength has been putting massive amounts of pressure on emerging market countries and companies. Really quick to sort of piggyback off of what you're saying. I believe that out of the entire S&P 500, about 40% of all the revenue in the S&P comes from abroad. So we talked about one of my theories that this broader stock market decline so far may have only been an instance to price in thought that was man, these planes are flying so low to the ground. Mainly have only been pricing in higher interest rates. I do not think the market has priced in an earnings recession yet. And in an environment where we have this ridiculous dollar strength, crazy dollar strength, being that 40% of the revenue in the S&P 500 comes from abroad, well, that could make a material impact to earnings. So I think as we go through Q4 and many analysts on Wall Street start to make their earnings revisions for the next fiscal year, I think we could see some rather harsh declines to those earnings projections and revisions. So we'll keep our eye on that. Hey, Daryl B says, good evening, Tom and everybody. Thank you, Daryl, for joining. I see my friend British Gray is here from Tampa, Florida. Welcome. The ABX girl is here, says, hey all, welcome. Business Mail says, Tom, the VIX has not breached 40 yet. Yeah, I mean, Business Mail makes a very good point. Very, very good point, because to Business Mail's point, usually during, I would say, major bear market bottoms, right? We're talking about when the market bottoms for sure and goes on to rally and start a new leg of a bull market. Usually we see the VIX, or the CBOE volatility index, spike to over 50. And the VIX today actually came down substantially. So I think the VIX closed at 30, all the way down from 34, and that's a pretty big move for the VIX. Now, we could go into some of the reasons why the VIX may not spike as high this time around. I think a lot of hedge funds and funds and things like that may already have been well positioned as it relates to being well hedged. But if you think back to previous major bear market bottoms, we talk about 2020 with the COVID crash. I think the VIX got above 70. If we look back to the 2018 stock market crash, where we actually bottomed on Christmas Eve, we had a huge spike in the VIX, and we haven't really seen that yet. So usually when things bottom, you'll have that one big blow off in the VIX. Haven't really seen it, to your point. Hey, Gregory says, good evening all. Just finished office hours. Well, hopefully you had a good day at work, Gregory. First day of the quarter. Happy Q4 to you, my friend. I'll give you guys one shot of the Aston Martin building here. Hey, Sam Miguel is here. Good to see you. Savi says, a very good Monday to you, Tom. Thank you, my friend. Appreciate you. This building is going to be fantastic when it is complete. We'll continue on our walk to Brickell. So there was two specific, I would say, categories in this month's PMI report that I really wanted to focus in on, that really caught my attention. So once again, if you want to follow along and you want to read the Institute for Supply Management PMI report yourself, if you type !PMI in the chat, the Nightbot will drop the link. But if you scroll down about halfway down the page in the link that the Nightbot will drop, I want you guys to check out the employment index, so the PMI employment index. And it's going to become relevant while we're talking about it in a minute, but the employment index registered 48.7% in September. Check this out. This was a 5.5 percentage point drop from August. August, we got a reading of about 54.2. So the index actually returned to contraction. So remember, when we're talking about PMIs, generally speaking, a reading of 50 or above signals expansion, and a reading of 49 or below signals contraction. So the indice returned to contraction as a higher number of panelists were saying that they were implementing hiring freezes for their business and actually allowing normal churn in their environment to reduce headcount for them. So if you remember a couple of streams ago, I would say even going back months now, we've been talking about this major problem a lot of businesses have been having with trying to increase their employee retention. So employee churn has been very high. But now, one of the respondents, if you look under the employment index, one of the respondents said something very interesting. They're saying, we're seeing an increase in churn, but we're actually allowing it to happen, so it'll reduce our employee size for us. Now that's a big red flag. So before I go on too far, I just want to get a quick update from the chat. Whatever sort of sector of the economy you're in, maybe you work in real estate, maybe you work in banking, maybe you work in tech. I know we've touched on this before, but are you guys seeing anything in your specific markets where, let's say if you were interviewing with the company and then they've essentially ghosted you or have not gotten back to you in the interview process? Has there been layoffs in your department? Have you yourself been personally laid off? What are you guys seeing out in the field? And then I'll sort of give you an update of what I'm seeing. Wendy England says, Tom, many restaurants here on less hours because they cannot get staff. Yeah, so Wendy England makes a good point. I was reading an article in the Wall Street Journal that says many of the large corporations are having a much easier time hiring and attracting employees than small businesses. So essentially, even as we get these PMI numbers and these economic readings saying, there's going to be hiring freezes and layoffs, a lot of the small businesses within the economy just can't keep people and can't hire people. Interesting stuff that's going on. James V says, I work for one of the largest gas utilities in the United States, and Tom, we're going on a hiring freeze. Wow. Well, thank you for that, James. That's huge insight for us. So James V says, I work for one of the largest gas utilities in the United States, and we're going on a hiring freeze. Jeez. UWU says, Tom, Healthcare Administration. We are reducing our workforce. Carlos DLT says, Tom, I work on utilities. I'm a contractor for FP&L. We cut trees by lines. Very nice. Very, very nice. PB on the go says, hey Tom, we'll be curious how Q4 ends the banking industry. So PB on the go, as it relates to banking in particular, one of the things that I've been saying is to sort of take a contrarian approach. Now, a lot of times when you turn on like CNBC or Bloomberg, over the past couple months, there's actually been a lot of analysts coming on with major bull theses for the major banks. But I've actually taken the opposite side of that trade, and I've sort of explained that position here before, but I guess I'll explain it again. I think it's appropriate for the stream. Now, I actually think that banks across the board are going to continue to hurt quite substantially here. And the reason for that is, obviously interest rates are going up, and generally speaking, that is traditionally very good for banks, right? When interest rates go up, banks can make more money on lending and things like that. But I think there's a bigger picture we need to look at from a little bit more of a macro view, especially as it relates to the investment banks. But for right now, we are standing outside the Cipriani, and just a little bit of on-premise market research here. This place is packed. A Monday night at Cipriani, Miami, and the place is packed. So what does that say about consumer spending? This is one of the most expensive restaurants, I believe, in Miami. Sort of like a club. They have them all over New York City, and the place is packed. But for two reasons, and here are my two reasons. As it relates to the investment banking business, initial public offerings or IPOs, as well as SPACs or special purpose acquisition companies, have absolutely fallen off a cliff. IPO activity down 97%. And if you look at a company like Goldman Sachs, Morgan Stanley, Bank of America, JP Morgan, they make a lot of their money off of fees or fee income, advisory services, equity underwriting fees, when they help companies go public or help companies buy other companies. That business has gone pretty much dropped 90% overnight. But also another one that not a lot of people are talking about, and that is the refinancing market. So we took a poll in the Walks on Wall Street chat about, we'll walk this way. We never walk this way. We took a poll in the Walks on Wall Street chat, I think about a week ago, asking everybody who owns a home with mortgage, so you still have debt on it, what is your interest rate? And quite literally, about 90% of the people in this chat said that they had an interest rate of about 5% or below, okay? So as of today's close, the average 30-year fixed rate mortgage, according to bankrate.com, was going for 7.06%. 7.06% on a 30-year fixed rate mortgage. So assuming the vast majority of people in our chat have interest rate on their 30-year fixed or 15-year fixed, whatever you want to call it, whatever you guys have, is below 7%, why would anybody want to refinance their house or refinance their mortgage? So that business is going to go to zero. And that was a very lucrative business for a lot of these banks. So you have those two main money makers essentially being wiped away. So I wouldn't be long the banks, in my view. And again, that's just my personal opinion. I'm not saying, for you guys to go out and short the banks. I'm just saying my personal opinion on the market in general. Hey, Steve French here. What's up, man? It says 3.25% here. Yeah, I mean, you're right. So if you have a 3.25% rate, why on earth would you ever refinance your loan? Ooh, I think this is a mariachi band here. This is cool. Check this out. This is really cool. I think these guys are going to start playing right now. Hey, Sabrina Fair is here. Good to see you. Haseen says, Tom, did you hear the news about the Credit Suisse bank? I did hear about it. I have a couple friends who work at Credit Suisse. I think we're in the fog of war phase right now. There's a lot of rumors swirling. A lot of people are looking at the credit default swaps on Credit Suisse. But I think a lot of the stuff you're seeing in the media and on Twitter come from people who really aren't that educated in the CDS market. So I think we're in sort of the fog of war phase. So I would just wait a couple weeks. I wouldn't panic too much. But the stock is, I think, $3. So there's definitely a problem. I just don't know how big the problem is. Wow, this is cool. What are the chances we come across a mariachi band? Hey, Ryan. I see Ryan Royal in the chat. Man, this is a really nice restaurant out here. Hey, Julia M is here. Hey, Julia. FredX, good to see you. So if you look right across the water here, this is Brickell Key. And we actually walked across here the other day. It was beautiful over here. Right now you're looking at the amazing Mandarin Oriental Hotel. And they also have another location in the Deutsche Bank Tower in New York City. But that was pretty cool, an awesome impromptu mariachi band. Now for a Monday night, things are pretty busy in Miami, Florida. Pretty busy. So I know we got a lot of feedback. Please check that out. Once again, if you type !PMI in the chat, it'll drop, the Nightbot will drop the link to the Purchasing Managers Index. And I'll read that piece of data from the Employment Index once again. So from the PMI, or the Institute of Supply Management Employee Index, it registered a 48.7% reading in September. That was about 5.5 full percentage points below the August reading and falling into the contraction territory. Now, listen to what one of the respondents are saying. They said that the index's return to contraction, as a higher number of our panelists are saying that they are passing on I was about to say rate hikes. They are passing on hiring freezes, and they are actually allowing the employees who quit to do so to reduce their employee size. So we've been talking about on the live streams how employee retention has been very, very, very hard to come by, especially in the, I would say, the realm of employers paying about $15 to $30 an hour. Employee retention has been really, really hard to come by. But now some of the respondents in the manufacturing sector are actually saying one of the things that we're moving forward with is allowing the employees who are churning just to do it. We want to reduce headcount, and this is an easy way for us to do it and sort of prepare for a coming recession. So total flip-flop. And we've been talking about this on the streams. I know a couple people actually just gave their inputs, what they're seeing on the ground floor. 2 streams ago, we actually heard from a couple software engineers in the cybersecurity space saying that not only are their particular companies implementing hiring freezes, they're actually trimming the fat in the organization, which means unfortunately laying people off and firing people. Now, I do want to give people on the stream an update of sort of what I'm seeing. I'm not sure if I told this story before, but I have a handful of friends that are interviewing or in the process of interviewing with some pretty big firms across the suite of hedge fund business, private equity, as well as tech. And essentially, they're very, very deep in the interview process, and it's just gone radio silence. Now, I know what you're thinking. You could say, well, maybe they're just not the best fit for the position, which may be true, but I think it's just too much of a coincidence that we see all of this talk in the news, some of the largest tech companies announcing hiring freezes, and now, in my own life, I have friends that are very, very deep in the weeds in the interview process of some of these big companies, essentially just being put on standstill. Hey, J87124, this is Tom. My first home loan back in 1989 was right around 12%, and that was pretty common. So I don't know why everybody today thinks money has to be handed to them. Want/get loan/world keeps turning. Jay, that's a fantastic comment. I think you win the comment of the night, my friend. You 100% win the comment of the night. And we've talked about this before on the live stream. When mortgage rates hit 5%, and that was a big deal. It was on the front page of the Wall Street Journal that mortgage rates for the first time in 8 years, hit 5%. And we were sort of talking about this. I'm like, look, when my parents went to buy a home, they had a 13% mortgage, right? So it's not like we haven't been here before, but I think humans are creatures of habit, right? And for somebody my age, right, 27 years old, haven't really lived through multiple, I would say, economic cycles in the housing market. And what I mean by that is, in my investing lifetime, right? So anybody, let's say, I would even push that number all the way up to about 35. So a lot of the millennials out there who are in their investing lifetime, they haven't really seen rates this high, right? We grew up in sort of a pre-GFS, or Great Financial Crisis, GFC, world where interest rates have been artificially suppressed. That's the world I grew up in. So, being that humans are creatures of habit, they're used to the Federal Reserve printing a bunch of money. They're used to the Federal Reserve buying U.S. Treasuries, mortgage-backed securities, suppressing interest rates. And the moment that changes, to your point, everybody starts to flip out and they don't know how to act. Now, my concern with this is that we've been living in a world where interest rates have been artificially suppressed for so long that not only individuals and individual American consumers are addicted to this cheap money, but so are businesses and organizations and big corporations. It's essentially you're addicted to that drug. And let's say if you're addicted to heroin, it's extremely, extremely hard to kick that addiction, right? So I think, to your point, a lot of people just aren't used to this, and that interest rates have been so low, there's probably 20 times the debt now. So as interest rates go up, it's definitely going to get harder to service that debt. But you're 100% right. It's a great comment. Yeah, Buff20 says that's what happens when children have never heard the word no. Mike C says if prices of homes get cut by 50% suddenly, people can afford higher interest rates, says Mike C. Agreed. Hey, BMST Group says play by the bank rules or pay. Banks control the currency flow of money, says BMST Group. Thank you so much for the comment. Gabriel says, I used to have my office in Brickell Key. Really? So Brickell Key is a fantastic place. It's a little bit too secluded for me, but Brickell Key is an amazing place. A lot of very, very nice apartment buildings, condominiums. It's just a little bit too far away from me. Hey, Raul says, Tom, a house in Miami is $500,000. In Orlando, it's $300,000 to $250,000 for the same home. Yeah, I guess that proves the point of location, 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 right? The vast majority of the valuation of your property is not necessarily what the house is constructed of, it's mostly the location where it is. You're 100% right. Hey, Jor's here. Just hope everybody's day has been fine. Thank you so much. My day has been fantastic. So everybody, check this out. So I wrote down, going back over the last 12 months, the readings on the Institute for Supply Management PMI report, so the Purchasing Managers Index. So I want to read this for you guys, and I want you to sort of notice a trend. And then we're going to talk about how that relates to the broader equity indices, such as the S&P 500, the Dow Jones Industrial Average, and the NASDAQ. So check this out. In November of 2021, so leading up into, I essentially took the numbers from Q4 last year, just so we can do a comparison. So in November of 2021, the PMI number was 60.6%. In December of 2021, the PMI was 58.8%. In January of 2022, the PMI was 57.6%. Are you noticing a trend? Skipping ahead to March, in March of 2022, the PMI number was 57.1%. April, 55%. In May, 56%. June, going lower to 53%. July, 52.8%. August, which was last month, was 52.8%. And now in September, we got a reading of 50.9%. So here's the trend I want you guys to notice. And this is why I always hammer this into your heads, that the vast majority of people don't know how to read these PMI reports, because they'll look at the big headline number on CNBC or Bloomberg and say, oh, the number is above 50. So that means everything is all well and good in the manufacturing sector, because a reading above 50 signals expansion and a reading below 50 signals contraction. That's an incorrect way to look at it. It's more so the trajectory of the PMI, okay? So let's take an additional step back and say, what was the exact date that the S&P 500 put in a top? The S&P 500, I think, and you guys please look this up if you go to TradingView or something like that, I believe the S&P 500 put in its top on January 4th, 2022. So what do you notice from January to now in the PMIs? The PMIs are decelerating and rolling over. So there's a very, very high correlation between the trajectory of those PMI numbers and S&P 500 earnings. So as you have the PMI numbers going up, let's say from 55 to 58 to 60 to 68, generally speaking, you'll see S&P 500 earnings go up. Look at these guys in the cars. I'm not a big fan of that. I've never been a big fan of that stuff. But anyway, but what you'll see is when you see the PMIs rising, in tandem, S&P 500 earnings will rise. And 90% of the time, you could draw the correlation between earnings growth and price appreciation in the equity market. Okay, earnings matter. It's all about earnings. So if you look at the PMIs, you're essentially looking at the business cycle. So what I do personally is I created an Excel spreadsheet, and you could literally make a dot plot, a line graph, whatever you want to do, and overlay the PMIs over any of the equity indices like the S&P 500, the NASDAQ. And what you'll see is once the PMIs start to roll over, you can pretty much draw a correlation when the stock market rolls over too. So that's the way that you should be interpreting, beautiful dog. That's the way that you should be interpreting that PMI report, not just saying, oh, it's above 50, I have nothing to worry about. That's definitely not the way to look at it. You want to look at the trend or the trajectory of that report. Hey, Joan is here. What's up, Joan? Good to see you. Thank you so much for joining us. We are now headed to Brickell. We are now at the East Tower. Tom G is here. Good to see you, Tom G. I see Arnold. Welcome, Arnold. Sabrina Fair is here. Raul says, is that still the Bank of America building? That used to be the tallest building when I was a kid. Yeah, so this is still the Bank of America Tower here in the financial district of Miami. Now, Raul, I'm not sure if you joined us for last night's live stream, but we actually visited the location where Citadel Securities will be building their super tall office tower. And Ken Griffin actually put out a statement, and we sort of went through this line item by line item yesterday, that not only is he going to invest, I think, $3 billion, I think that's how much the tower is going to cost, but he's actually going to personally try to convince some of the top CEOs in the S&P to move satellite offices or just move their entire offices to his building here in Miami to attract additional job growth to the community. So Ken Griffin seems to be making a pretty big bet on Miami, and hopefully his bets will pay off. We'll see. Hey, Louise is here. Good to see you, Louise. Welcome. Hope you're well. Hey, Ken is here. Ken says, Tom keeps me hydrated. I take a sip of water every time he says Brickell. Love that. Dan Zhang says, Tom, did the hiring freeze affect your industry? Are they still hiring in tech sales? Well, here's what I've been hearing from a lot of my buddies at other tech companies, as well as hardware companies too. Like Cradlepoint. I have a lot of friends at Cradlepoint. And here's sort of how that works when you're entering a recession. I always talk about how the closer you are to the revenue, the safer you're traditionally going to be, assuming that you're hitting your quota and you're not, derelict in your duties, things like that. But it usually works like this when you're going into an economic downturn within a sales org. You'll have very, very scrupulous analysis of the salespeople. So the people who are not performing, they usually move you on PIP, and it is not a fun time. And it's very, very soul-crushing to have managers micromanage you, and they essentially manage you out of the business. The lower performers, essentially anybody who's hitting about 50% of their quota, they're going to be gone, because the company's either going to make life so terrible for you to be there that you'll just want to quit on your own, or they're going to put you on PIP and then they're going to fire you. And then usually the top 25% of the sales organization is solid. You're good, you're safe. They suspend hiring for a little bit. You'll have your sales teams shrink substantially. And then a few months go by, if the numbers continue to stay elevated, as in after you fired all those people, if your teams are still hitting your numbers, they probably won't hire anybody. But if the numbers drop a little bit, they'll probably open up a couple headcount on specific teams, if that makes sense. So let's say if you work for a software company in New York City, there's probably going to be about 5 sales teams, either, Long Island, Queens, New York, New Jersey, Manhattan, selling into the tri-state area. It's probably about 5 sales teams. So they look to cut sort of the weak links, keep only the top performers. The sales teams get a little bit smaller, and then they let a couple of quarters roll by. And if the numbers aren't really taking a dip, they'll hold steady on the head count. But if numbers take a dip and people are getting spread too thin, managers or senior managers will start to open up additional headcount on those sales teams. And I haven't been seeing too much of that, but I have been seeing more from the friends that I've been talking to. Management has been a little bit more micromanaging in a way. And I think that is for this particular reason, if that makes sense. Hey, Brian is here. It's a super competitive job. Yeah, I mean, sales definitely isn't for everybody. Sales is, very high pressure to perform, for sure. Hey, NYC Dub says, Tom, you will always have a job if you have revenue behind your name. For service industry, the company is just a clearinghouse for the producers. Hey, Dr. Longus says, hey, Tom and Walks on Wall Street team. What is up, Dr. Longus? Zin Lee says, Walks on Wall Street, thoughts on building a wall for illegal? We don't really go into that stuff here. It's Walks on Wall Street. Very seldom do we talk about border policy. Deja Vu says, trust McKinsey Consultants. Deep Value Alex says, I know there's been a substantial amount of mortgage loan underwriters that have been laid off due to not enough demand, which it could be a trickling effect in the real estate industry. Oh, absolutely. Yeah, I agree with that 100%. And there's actually some small, mortgage companies, brokers, lenders that are actually going under. And which leads me to believe, there's been a lot of announcements at major banks that they're going through layoffs. And I think it's going to be very, very secluded, potentially to the real estate industry and maybe in investment banking a little bit, especially if you're working on bringing a company public or something like that, because your deal flow has essentially fallen off a cliff, right? We talked about this in 2021. It was a record year for initial public offerings. From 2021 to 2022, IPO activity dropped 97%. Same thing with the special purpose acquisition market, or the SPAC market, which has just been an absolute disaster. Another thing I wanted to talk about real quick. Ooh, Nick Rock says, I'm a mortgage processor and I'm laid off, affecting the whole industry. Oh man, Nick, jeez. Sorry to hear that. So Nick, what do you plan to do? Do you plan to make a pivot to a new industry, or what do you think? So Nick, that has a sense, I'm not sure if you just joined the chat or not, but the consensus trade, especially if I've been watching CNBC, and there's been a lot of people over the last couple months that have been coming on CNBC and saying, it's a good idea to buy the banks here because interest rates are going up. But to me, I'm like, yeah, it's okay that interest rates are going up, but you have to understand the environment. We talked about the refinancing market is pretty much gone because we've had artificially suppressed interest rates since the great financial crisis. So if the vast majority of people already have their home loans under 5%, as of today, according to Bankrate, the average 30-year fixed rate mortgage is 7%. Who's going to be refinancing their loans? Right? Nobody. So that entire portion of your business is gone to zero. In addition to your investment banking fees is down substantially from 2021. So I wouldn't be too bullish on the banks here. So this is one of the Lucid Motor EVs, or electric vehicles. Check this thing out. Hey, fourth quarter says, hey Tom, how's the humidity in Miami? It's not too bad. I mean, I would say, I do, thank you for reminding me, I have a real estate update for everybody. But it's not too bad. The humidity is not bad, especially during this time of year in Miami. Now it's sort of getting nice. But Nick rocks. If you're looking to make an industry change or you need help, shoot me an email or join us on the Discord. If I know of anybody who's hiring in like the tech industry, if you want to maybe have a go at it in tech sales, I mean, I'll try to help as best I can. It's never ever fun to get laid off. Yeah, Nick Rock says no one is refinancing. People are putting a lot of money down and only financing very little, says Nick. Thank you for that piece of information. And that's why I think bank earnings are going to drop substantially. That has been my thesis. I'm like, yeah, traditionally it's very good when interest rates are high. It increases bank earnings, but you sort of have this magic elixir, very interesting environment we're in, where you've had a decade of suppressed rates, and then you bring rates to 7%. You killed your business in refinancing, and the IPO business fell off a cliff. So it's definitely not the best bull thesis. Zinli says, is it easier to get a job in New York or Miami? I guess it really just depends on what industry you're going into. Just really depends. Iris Lewis here says, good evening, everybody. Hey, Iris, good to see you. Rachel Abreu says, cold front coming through Miami this week. It's not actually too terrible here. The humidity has been very, very low. So I wanted to bring something else up before I forget. Within the PMI report. Now, the two things I wanted to highlight tonight was the employment as well as price. So we already covered employment, and I think we covered that pretty good. But now I want to cover prices, because inflation is definitely a major factor as it relates to monetary policy decision. So if we look at the price index in the PMI, we got about a 51.7% reading in September. That is about 0.8% lower versus August. August came in at about 52.5%. Now, over the past 6 months, the index has decreased by 35 percentage points. And here's what one of the respondents is saying. So just keep this in mind. Over the past 6 months, the price index has decreased by 35 percentage points, which is good news when we're talking about inflation. So one of the respondents says the slowing in price increases is being driven by 3 specific things. And I'd like to read those things for you guys. You could follow along, by the way, if you type !PMI. You could actually read this for yourself. But it says 1 is the relaxation in the energy markets. Number 2 is the softening in the copper, steel, and aluminum markets, which we've also been talking about for quite some time. We've been looking at some of the commodities futures coming down substantially. But number 3 is the sluggishness in the chemicals and plastic demand. So out of all of the respondents, about 28% of all the respondents reported paying lower prices in the manufacturing sector. So it's only a matter of time, or is it, that those cost decreases start to be passed on to US consumers. And it's the exact opposite in an inflationary environment. You know, we've been covering all of these Institute for Supply Management PMI reports for the last year now on the channel. And one of the things I said was, when the price indice was going up exponentially, I'm like, this is going to be really bad for inflation, because corporate America, very seldom do they allow themselves to take a substantial hit to their profits and their gross margins. And that's exactly what happens. So when prices go up, what does corporate America do? They just increase their prices to maintain their profit margins and pass those price increases on to the consumers, me and you, and that's when we get our faces ripped off. But now, maybe after this PMI report we got today, maybe it's time to put our faces back on a little bit, because 28% of the respondents are saying that they're paying lower prices. So prices are coming down, but I think it's gonna take a little bit of time before we see those prices actually start to reflect in our daily lives. I think it may take a while. Buff20 says, need to get the lithium battery or lithium refining business. Oh, need to get in there? Interesting. Prototype says, Tom, this is price gouging. Raul says, referring to chip plants and electronics. Raul says, hopefully the new plants they built propel the market, but we're talking about 5 years from now before we see returns. Yeah, Raul, I think you're spot on. So I think Raul brings up a good point. And we've been talking about this for a while, the domesticating the supply chain. And I think COVID really taught everybody a lesson, especially in the United States, that you really can't rely on policy in any other country. Now, I didn't want to make this stream too political, but if you notice, if you look through that Institute for Supply Management PMI report for September, there was 2 of the respondents that actually noted the zero COVID policy in China as still putting pressure on supply chains, still. So if you have continuous pressure on supply chains, specifically from zero COVID policy, do you think that big businesses are going to move more manufacturing capacity to China or take it away? I think you guys know the answer. It's definitely take it away. You know, Apple has already moved some of their iPad manufacturing away from China to India. We're seeing a lot of the semiconductor companies like Intel and Nvidia investing billions of dollars in the United States to build their own chip fabs. So I think it's important to watch. Hey, Teresa Diaz is here. Says, Tom, 21,500 subscribers. Congrats to the team. Hey, Teresa Diaz, thank you so much. I appreciate it. Thank you for your kind donation. That's insane. Man, the channel's, I never imagined in a million years the channel would grow this fast. But I appreciate everybody. I really do, from the bottom of my heart. This live stream is something I look forward to every night. I think it is, you know what I really like about the live stream? I'll tell you guys real quick and then we'll get back on topic. And I was thinking about this the other day because, has anybody heard of the company called GuidePoint or Third Bridge? So I am actually a consultant in the GuidePoint talent pool. And essentially what they do, let's say if a specific mutual fund or a hedge fund wants to consult with an expert, or it doesn't necessarily have to be in the financial industry. It could be anything, right? Somebody wants to consult. Check out this dog here. Beautiful. It could just be anybody wants to consult with an expert in an industry. So I am registered as one of the consultants in GuidePoint, specifically for like fixed wireless and SD-WAN, mainly because I've sold those type of solutions before. And, you know, if anybody wants to talk, they could book a consultation. And my rate is actually $150. But one of my buddies who actually used to be an associate at Third Bridge said I should probably raise my consultation rate a little bit. Anyway, I'm getting off track. But those consultations, again, cost, you know, $150 an hour. Sometimes if you're a real big wig, it could be in the thousands of dollars an hour to consult on a specific topic and get industry feedback. And we do that here for free on the stream, if you think about it. You know, we have all of these people from all over the world. We have people who work in banking, who work in technology, who work in the housing market, who work in construction. And everybody comes here every night and openly, for free, shares their ideas and free market research with everybody. I mean, that's invaluable. I don't know, I'm ranting, but I really appreciate it because I've been learning a ton, and the network that I've built here, you guys are fantastic. And the people I've met through the live stream are some of the best people I've ever met in my life. So I appreciate everybody. Man, this is a beautiful, beautiful location here. So in the distance, you could actually see the Metro mover going over the bridge right here. But this bridge is a little different, everybody, the one that has all the rainbows on it. I think this is the Metro Rail, which is a little bit different than the Metro mover. So here in Miami, we have, I guess, 3 different trains. One of them is the Metro mover, which is free. The Metro Rail, I'm not sure if that is free. And then we also have the Bright Line, which is very, very nice. Never been on it before. Hey, Joe Driver, appreciate it, my friend. Oh, we got the Metro mover coming over right now. I mean, the Metro Rail. Nice. So real quick, does anybody know what this is here? Is this sort of like a blocker so the boats don't sort of beach themselves? I'm not too sure. Hey, Siva says, I appreciate your thought process. I appreciate you. Appreciate you very much. Prototypes is Skillshare actually legit? Can I learn real estate in Skillshare? Prototype, I'm afraid I haven't heard of Skillshare. What is that? Could you expand on that a little bit? I've never heard of it, Skillshare. Bob's is Metro Rail Bridge, and the neon is for art in public places program. Copy that. Man, this is a beautiful, beautiful view here. I could sit here all day. You have the City National Bank building, Miami Tower, Wells Fargo building. You know what's another crazy thing about Miami? Everywhere you turn, it seems like they have a new construction, super tall building coming around. Hey, Disney Hatch, good to see you. Hey, Rachel Abreu says, where are you? So I believe this is the northernmost side of Brickell. So that is the Brickell City Center. But I guess this is called the Underline here, which is quite nice. Oh, I think we got another train coming over. Let's see. I'll walk across this side so you guys can see it. I heard it, but I didn't see it. Oh, it looks like there's 2 Bank of America towers. There's another Bank of America tower right here. Crazy. Mike C says, all I know about Skillshare is half the YouTubers seem to have it as a sponsor. I've never heard of it. I'm surprised. I'll have to check it out. Deep Value Alex's Skillshare is an online learning community. I'm definitely interested in it. I'm gonna check it out. Let me do my research on it and I'll get back to you, because I've quite honestly never heard it and I don't want to blow smoke and pretend I know what I'm talking about. But I am interested, and maybe I will do some diligence on it as I take my flight. Might as well walk down here. I don't think we've ever been down here on the stream. All right, let's talk key levels. Can we do that? Let's talk some key levels here. So we did have a very, very nice rally day on Wall Street. Now, what does this mean? Is this the bottom? Is the bear market over? Is this the start of a new bull advance? Well, let's try to unpack it. The short answer is I don't know, but let's sort of try to piece the puzzle together and unpack it. And I think there is a couple things we need to look at, and I sort of say this all the time, almost probably too much, but I think it's very important. Here's some of the mechanics I look at almost every single day, and there's been a very, very clear trend that has emerged. Now, generally speaking, usually when we have that 10-year US Treasury yield coming down, usually we have a positive day in the stock market. And if we sort of understand how that mechanic works, when people are buying bonds, I'm not sure who it was. Maybe it's the Fed, maybe it's not. But when there's demand for treasuries and people are buying bonds, yields tend to come down. And that really helps valuations of very high growth sort of tech stocks and things like that. And it alleviates the bond markets a little bit. So 10-year US Treasury yield came down substantially today at about 3.609%. But the 2-year Treasury also came down a little bit at 4.08%. So still, we're pretty inverted across the board in the yield curve. Well, check out this little mini fishing boat. This thing is cool. But another thing is the Dixie, or the dollar, has actually come down substantially. Now, we've been talking about the emerging markets. So a very good ETF to monitor the movements of emerging market stocks is VWO. Now, again, this isn't, I'm saying go buy this. I'm saying you should have it on your screen so you could look at how the emerging market indices are doing. So VWO is an ETF that tracks emerging markets. And that actually saw a little bit of a bid today. And I think that is because the dollar actually fell for the first time in almost a month. I think we have retraced all the way down to about 111. If you remember, we hit a high of 114. And dollar strength really crushes emerging markets and emerging market countries that hold a lot of dollar denominated debt. So I think that's why we had a little bit of a rally day today on Wall Street. We had the S&P 500 was up, I believe, 2.59% to about 3,678. We had the Dow Jones Industrial Average up about 2.66% to 29,490. And we also had the NASDAQ Composite with a gain of 2.27% to 10,815. Now, where are some of the potential targets we could look here? Well, if you go to tradingview.com or anything like that, put a 50-day moving average across the board on all the major equity indices. And we have been historically extended to the downside across the board. And I believe the S&P 500 as of Friday's close was 10% extended to the downside from the 50-day. So usually we'll see a little bit of an oversold bounce there. So as of right now, if we want to look at some key levels to watch where the market may rally to, I would look at the 50-day moving average. So as of right now, the 50-day moving average is sitting at about 4,000 on the S&P. It's sitting at about 31,800 on the Dow Jones Industrial Average, and it's sitting at about 12,000 even on the NASDAQ. So these are some key levels here we could be potentially watching for, where price action may rally to. And the reason why I say that is because if you go back to the June 2022 low, when we had that very big summer rally on Wall Street, we rallied all the way back to the moving averages and then we rolled back over. So there's no reason we can't do that again. So I think those are some levels we should watch here. But what about for you guys in the chat? Are there any specific levels that you're watching? Do you think that this is going to be the start of a new bull market? Or do you think this is just another bear market rally and that we're going to continue lower through Q4? Hey, Thomas is here. What's up, Thomas? Thomas Ellis is good evening from Pennsylvania. Love it. What part of Pennsylvania? I may be in Philadelphia very soon. I have a bunch of buddies from Pittsburgh. Love that city. I think we've actually talked about before, I'm very bullish long-term on rental real estate in the Pittsburgh market, but more on that later. Dr. Longest bear market rally for sure. Oh, FredEx. This is Tommy, you going to Frisco. Update, FredEx, quick update for you. I am not going to Frisco, but I will be doing my meetings virtually. So I do not have to travel to Frisco, Texas. I thought I was going to, but I do not have to. I'll just be doing my meetings virtually. Hey, Milton is here. It says, Tom, what's your opinion on the recent move of illegal immigrants from Florida to Texas to New York City? I try not to really get into that too much, just because I know it's a big hot button issue, and I do live stream in the streets, and everybody knows my location. So depending on what I say, my opinion on that, people are going to get upset. But I'll give you a little bit of a look into my mind. I think that the crisis at the border is the biggest travesty ever. Not only for American citizens, but for these poor people that are coming here. You know, I was looking at some of the footage. There's even better footage on Twitter. And people are coming to the United States. And this is why I always revert back to, I am extremely thankful and grateful to be an American. Because if you think about, everybody wants to talk about, you know, white privilege, this privilege, that privilege. In my view, there's only one particular privilege, and that is if you were born in the United States. You did nothing special to be born here. You just won the lottery, okay? You could have been born in one of these countries where people are fleeing tyranny. You could have been born in Cuba or something. I didn't do anything to be born in the United States. I just won the luck of the draw. Okay, so if anybody wants to talk about some type of privilege, if you're born in a free country, because the rest of the world is a very, very dark place. And so I'm just extremely grateful and thankful every day to have won the ultimate lottery in the world, bar none, which is to be an American. Because I didn't do anything special to be here. I just hit the lottery. My parents were, you know, got together and had me, and I was born in New York. And the percentage chance of that happening is next to zero. So I have an increased sympathy for people who didn't have that ability to be born here. So it's hard for me to say, oh, these people shouldn't come here, because I was born in, literally, you know, I wasn't born wealthy, but regular. No, even if you're born in poverty in the United States, it's way better off than being born in poverty somewhere else in a third world country. So we were pretty much born into a life of luxury. So I have no idea what these people go through. It's probably hell. So do I want immigrants to come here? 1,000%. Do I think the United States should be pressuring countries a little bit more to get their act together? Absolutely, because at the end of the day, a lot of these countries, it seems like their governments have absolutely fallen to disgusting cartels that are, you know, using their own citizens as, you know, sex slaves and just horrible, horrendous things. So I don't think we should be doing like publicity stunts with shipping people around. I think we should come together as Democrats and Republicans and figure out the crisis at the border, because it's horrible. These people are living in squalor conditions and risking their lives walking here with their children to come to America. And it's almost, I can't even comprehend it. So I think Mexico needs to do a better job with fighting the cartels. I think the United States needs to do a better job with all this fentanyl that's coming across the border and killing Americans here. But I am very, very, very pro-immigration. And I think one of the best things that the United States could be doing, if I had to advise President Joe Biden right now, one of the things I would say is you need to open up the H-1B visa program, because there's a lot of very, very smart and brilliant people from all over the world that are having an extremely, extremely difficult time coming to the United States because they can't get an H-1B visa approved. So I think we should automatically open that up to everybody. We do have a labor shortage in this country, and we, you know, as an American, quite selfishly, I want all the best and brightest and smartest people from all over the world to come here to build a business, to come to the United States I sort of want all of the talent to be sucked here, right? As a competitor, as an American, why would I want the smartest people, building businesses in China, building businesses in Europe? I want them building it here. So, I don't know, it's sort of a long-winded response. I usually don't really like getting into it, but hopefully that makes sense, I guess. Oh, look at this dog here. A dog has its own seat. That's hilarious. So this is the Mary Brickell Village. Now, the interesting thing about this is it's going to be totally demolished, and they're going to build additional super tall towers here. But check out that full moon here. Wow, NMB 045 says, Tom, my employer halted their warehouse expansion project. Whew. Yeah, I mean, NMB 045, we were just talking about that. In the PMI report today, I think 28% of the respondents said that they are going on a hiring freeze, and they are not replacing their employees that are churning. So it's this seems to be getting pretty broad-based, and I know that NMB 045 is in Canada, so it seems to be spreading to other countries too. It's not only a United States economic downturn. There's an old saying on Wall Street that if the United States catches, or if the United States gets the flu, the rest of the world catches a cold. And I think that's exactly what's happening right now. Yeah, Arsenal Fan 13 says Amazon is halting warehouse expansions as well. I read a crazy article in Barron's that Jeff Bezos bought a ridiculous amount of warehouse space, and he's actually trying to renege on a lot of those contracts because he was basing all of this demand on that artificial COVID demand. And if we've paid attention to the earnings report of FedEx, FedEx is predicting that a lot of packages and shipping velocity is going to fall off a cliff, and they're actually closing up to 90 FedEx store locations and actually halting Sunday delivery in many parts of the United States. So if we understand that consumers, we looked at the consumer spending reports. Consumer spending is still strong. The difference is we've just changed what we're spending on, right? Consumers are not spending on ordering trinkets from Amazon anymore. We're spending on vacations, airfare, travel, going to movies, things like that, which I also have a prediction for everybody. And here's my prediction. I wanted to give it a little bit later in the stream, but I might as well give it now. I think that this Thanksgiving, in the United States is going to set an absolute record for travel. And the reason why I say that is because Labor Day, which is pretty much known as the last hoorah of summer, set an all-time record for travel spending in the United States. So I think this holiday season is going to set records as it relates to traveling, not necessarily spending on gifts and presents and things like that, but I think travel in general is going to absolutely explode, and travel is going to be a nightmare at the airports, trains, everything this holiday season. That is my prediction. Hey, Leo is here. Good to see you. This is good evening. Is it a good time to buy an apartment in Miami? I think it depends on where you're buying, but I would wait a couple quarters if I were you, because interest rates are going up. A 30-year fixed rate mortgage is about 7%. I would wait till Q2 of next year and see where prices are, because if I had to bet, I think prices are going to cool here a little bit with higher interest rates, and you may get a better deal. You never know. Julia M says, so then that means everybody still has a lot of money to spend. Well, so Julia, to your point, if you remember a couple streams ago, we were talking about this particular interview with Stanley Druckenmiller. Now, one of the things he says is that he's predicting, hold on, I think there's another, oh no. Stanley Druckenmiller is predicting a recession in 2023, But what he said is that consumers, or the average American middle class, right? Let's just take American consumers in general. They have about $2 trillion in savings from the pandemic. And it may take a little bit to work off of that savings. So the recession may be delayed a little bit. In my view, I call it we're already in a recession since last quarter. I'm just going based upon the 2 consecutive quarters of negative GDP growth. But to your point, according to the data, Americans still have about a $2 trillion cash balance. And that may take some time to wither away. Yeah, Mike C says, Tom, people are still willing to spend on experiences. Milton says, Europe is already in an unofficial recession. When will the United States hit one? Again, like I said, I think we are already in one, in my view. I mean, just look at the PMIs. Like, look at the topic for tonight's stream, right? The topic for tonight's stream is the Institute for Supply Management, the Purchasing Managers Index. And a little bit earlier on in the stream, I actually did a 12-month look back, and I looked at all of the PMI numbers going back over the last year. And in November of 2021, the PMI was at 60. Now, the PMI as of September is at 50. So you've had a massive rollover in the PMIs. Now, again, I'll sort of reiterate this. If you listen to the mainstream financial channels like CNBC, they'll just tell you, oh, the PMIs came in at 50 this month. That means the manufacturing sector is expanding. That's not the right way to look at it. You have to look at the trajectory of the PMIs. If in November of 2021, we were at a 60 PMI and we've rolled over all the way down to 50. Well, I mean, you're looking at the business cycle in real time. You're seeing huge deceleration in the manufacturing sector. And along with that, the S&P 500 is rolled over. So along with that, along with declining PMIs, as well as 2 consecutive quarters of contraction as it relates to GDP, I would argue that we're already in one, but that's just me. Oh, I think it's starting to rain. It actually feels kind of nice. Charles D says, if the middle class put $2 trillion in the stock market, what would happen? I don't know. I mean, to your point, Charles, I think I was looking at a Bank of America report. And the Bank of America report said that fund managers or money managers on Wall Street had some of the highest cash levels in history, which could also be fuel for another market rally. Now, I think this rally that started today is probably going to be a bear market rally, but it may be forceful. I mean, I don't know. I think you have a lot of people short this market, a lot of people bearish this market, so we may rally to the 50-day. Oh, I do want to say something a little bit funny here. If you guys are following me on Twitter, if you follow @WalksWallStreet, you'll notice what I tweeted on Saturday. And it was something kind of funny. I said, I'm going to post a bunch of bearish charts in hopes that the market is probably going to rally hard on Monday. So all of the charts that I published, I'm like, okay, these charts look like crap. I think these stocks are going to go lower. And I'm like, you know what? Anytime I get this bearish, the market always rips my face off to the upside. And that's exactly what happened today. Now, I still think the market is going to go lower, but I think markets don't go down in a straight line, right? Markets rally, you have these crazy face-ripping bear market rallies, and then you roll over. But I just thought it was kind of funny that I sometimes go on these calls with one of my buddies who's runs a pretty notable hedge fund. And every time we get extremely bearish and look at these charts and we're like, oh my gosh, this looks horrible, the market has a green day almost every single day when I get that bearish. It never fails. So feel free to use me as a contrarian indicator. All right, so now we are Southeast 9th Street outside of the Chipotle. Chipotle is rocking, ticker symbol CMG. I think Chipotle's stock price is actually doing pretty good. You know, this is one of those maybe recession-proof businesses. I don't own any of the stock, so I'm not pumping it. Disney Matt says, hey Tom, is the Metro Mover good to get around downtown? How can you get to Wynwood from downtown? That's a very good question. So from Wynwood to downtown, it's a little bit of a pain, I'm not gonna lie, because there's no train service that goes up to Wynwood. However, I think that Wynwood is getting so popular, they're gonna be forced to either expand the, either one of the train services, Metro Rail, whatever it is, to Wynwood, because just so many people live there. But if you want to get there, I think you got to take the bus, which is a little bit cumbersome for most people. For me, I've been taking the bus here almost every single day. I've never had a problem. But the Metro Mover will really only get you from the Frost Science Museum to the Omni, downtown Miami, and Brickell. It doesn't really go anywhere else from there. That's a good question. Wynwood is one of my favorite spots in all of Miami. And it's a shame that we can't really live stream from there because the internet is just not good. So this is the SLX Lux building. Julia M says, Tom, what channels do you watch for financial news? I really only read 3 publications that I think are credible. I think there's a lot of fake news out there on both the right and the left. So I get the majority. I read the Wall Street Journal, I read Barron's, and I read Investors Business Daily. And sometimes Bloomberg. I'll use one of my friend's Bloomberg terminals if it's available. But that's really about it. I think those 3 and you're golden. Wall Street Journal, Barron's, and IBD. Those are really good publications. But if you guys are enjoying the live stream tonight, feel free to leave a like on the video and hit the subscribe button if you're new. We do these live streams about 5 days a week at 8:30 p.m. between New York City and Miami, Florida. Monday through Friday, we talk about the financial markets. Saturday, we sort of hang out, and Sunday, if we're in New York, we're usually hanging out on the Staten Island ferry. So we would love for you guys to subscribe and join us. Prototypes is Vice City looking clean and lively as if it wasn't affected by Ian. Yeah, I mean, thank God Miami, Florida was really, really untouched. I mean, we did go through a little bit of Hurricane Ian bands, but it only lasted maybe like an hour, hour and a half max. But we were pretty much fine from Hurricane Ian. Thank God. Hey, Brian says, Tom, any business traveling itinerary coming up? So I was supposed to be in Frisco, Texas. I think I told you guys I'm working with a big oil and gas company. I won a contract to, hold on, you guys know me, I do not trust any drivers here in Miami. And that's coming from a New Yorker. And our drivers are horrible. I'm working with an oil and gas company to procure a lot of intrinsically safe devices. So a lot of oil and gas companies, big chemical companies, they need to have intrinsically safe devices when they're out in the field for obvious reasons. So I've been doing that, which has been a little bit of a pain because the OEMs that I'm working with, everybody is still really struggling with the supply chain issues, but not as bad as before. I will say, without a bias, it's not has been as bad. During the pandemic, our lead times on like routers specifically. So I've been selling a lot, especially during the pandemic. Once the pandemic hit, I sold a ton of like the Cradle Point routers. If anybody knows, maybe some of you know, but they were almost impossible to get for obvious reasons. Chip shortage. Everybody wanted to build out like some sort of a SD-WAN network all at once because they had a ton of remote employees. and a lot of remote sites for COVID testing, things like that. So I did a lot of router business, and it was almost near impossible to get it. And if you did get your hands on it, you paid a pretty penny for it. You know what? Since it's raining, I'm going to take a little bit of a cop out, and I'm going to take the Metro Mover. So I don't have my umbrella. So I'll take you guys in the Metro Mover again. So I was supposed to go to Frisco, Texas, but now I don't have to. So I will be taking those calls remotely. And maybe we'll be back in New York City sometime. Dr. Longus, we should, depending on weather, we should have the streams up. All right, so this is the Metro Mover station at the Brickell City Center. Very beautiful here. So did anybody see this? There was a piece of news that came through the Wall Street Journal today. I didn't have enough time to look into it too much, but supposedly the United Nations is calling on the Federal Reserve to halt their interest rate increases. Did anybody hear that? It's very, very strange and weird. Has anybody sort of looked into that headline? I haven't had time today. I was pretty busy at work, but supposedly the United Nations has called on the Federal Reserve to stop raising rates. Since when does that happen? Hey, Juan Carlos is here. Hey, Juan. This is great stream, beautiful Miami. Thank you, Juan. Appreciate that. DWG says, yes, you heard about it. So what did it say? I didn't get a chance to read the article. Anybody up to date on that? Anybody could fill me in? Rachel says, I saw that they're trying to prevent a global recession. Well, I could speculate. I don't really like to speculate, but I can give you my opinion. Cabrera says, what did you study in college? Love the stream, by the way. I'm in Miami. Hey, awesome. I studied criminal justice with a minor in economics. And I thought it was all right. Dub says, yeah, I saw that the UN protecting emerging market economies from going under. So that was going to be my prediction. So yeah, I mean, that you're thinking exactly what I'm thinking. So Charles, I would compare it to like Midtown between probably 45th and Rockefeller Center. That's what I would compare it to. Yeah, photos from around New York. If you could post a link to the Reuters article, that'd be great. I just didn't have a chance to read it. I just saw a headline that says the United Nations is calling on the Federal Reserve to stop raising rates.
The train to downtown is arriving. Stand back from the
And I think you're exactly right. I think it was Dub who said that. Because as the Fed has been raising rates, that has been pushing up the yield curve. So the 10-year U.S. Treasury yield has gone gangbusters, going to the moon, and that's been putting a lot of pressure on the U.S. dollar. And as the dollar has been rising, that has been crushing a lot of these emerging market currencies in countries, especially the ones who have a lot of dollar-denominated debt. So maybe the United Nations sees some turmoil on the horizon. Maybe that's it, but it's just very strange. All right, we're gonna get on the Metro Mover here. I think we gotta take it 2 stops. Yeah, Robert says it sounds like the United Nations and International Monetary Fund are getting really involved in individual countries' economic policies. Yeah, I mean, it seems that way too. So The Metromover is free.
5th Street Station.
Please hold on. The train is approaching. 5th Street Station.
If you look all the way in the distance, you can see the Miami Tower and the Paramount Tower. Ooh, Jacob O'Brien. I want to keep that in mind. I'll let you know when I get off the Metromover. Psychic.
The next stop is Riverwalk Station. Please hold on. The train is approaching. Riverwalk Station.
So here's the inside of the Metromover. Pretty clean, but there's no seats, so a little bit different than the New York City subway. But very clean. I've noticed all the Metromover stations are spotless. Nothing like the New York City subway where you have filth, trash all over. Now, I love New York City, so that's not a dig at New York. I'm just making an observation. Oh, Brad's brain says I may be a little bit late to an interesting conversation. So we were briefly talking about, there was some news that the United Nations came out and is trying to, I would say, reprimand the Federal Reserve from raising interest rates. And we were just trying to speculate as to why. I just haven't had a chance to read the article yet, but I think it's probably because they see that emerging markets are going to get creamed, and they've already been getting creamed. But tonight we did a complete deep dive into the Institute for Supply Management Purchasing Managers Index. So if you missed it, if you type !PMI in the chat, the Nightbot will drop the link to the report and you could read it. It was not very positive report though. So here's the loop. Yeah, the bandit, very true.
The next stop is Grand Central Station. Transfer here for Inner Loop, Miami Avenue and Grand Central Station. Hold on. The train is approaching. Next Central Station. Transfer here for
All right, so this is the, where are we? Oh, okay, yeah, we're right by the Miami Convention Center. All right, this is good.
An interloop train is arriving. Stand back from the platform edge.
Yeah, so Ben says it seems like a slow train. It is a slow train. I think the reason why it's slow is because it's all elevated on this track. Hey, War Walker, what's up, man? I'm just figuring out the Metro Mover. I'm getting the hang of things. All right, but we will exit and then we will walk back to the 200 Southeast Financial Center. And we should be exiting at the Miami Convention Center. Hey, Dubs, this is great stream. Gotta go. Thank you, man. Thank you for joining. We'll see you tomorrow. Wow, these are like some New York City escalators right here. This reminds me like I'm getting off on the Upper East Side. Has anybody ever gotten off on like Lexington Avenue on the 6 train, something like that? And you have to walk down probably like 20 stories. Ooh, there's more. I don't think we've ever been here. So the Night Center Ferry, or to the office. Let's go to the office, let's see. Oh wow, so this is probably the lobby of the Miami Tower. Wonder how we get out of here. Oh, this way, hotel lobby. Disney Matt says, can you give me any recommendations? So I haven't really eaten too much stuff in Brickell yet. There was that one very good Argentine restaurant, which is my favorite. I forget the name of it, but I always point it out on the stream. Maybe Disney Matt knows. Wow, this thing is crazy. This is cool. Never been here. So the Night Center, the Hyatt Regency. This is the Miami Beach ferry you can get to. So Jacob, I didn't really see what Chamath said, but we may be getting closer to a bottom, perhaps. But I think so long as the Federal Reserve continues to raise rates and quantitative tightening persists, I think we're going to stay in this bear trend. Oh, look at that. Mike says, are the restaurants the same price as New York? Similar, but not as egregious, but similar, I would say. Well, I don't know where we're going, so this is interesting. This is fun, dude. Jacob says, how long do you think the Fed can keep raising? So I shared a really good Barron's article with everybody, and it actually gave that prediction. If you join our Discord, link in the description, I shared it with everybody. Now, there's a very prominent analyst on Wall Street that believes if the 10-year US Treasury yield reaches 4.5%, something is going to break and the Fed will be forced to pivot. And if the 10-year Treasury yield is 4.5%, that probably means Fed funds rates are exactly at that or a little bit below. Oh wow, this is the lobby of the Hyatt Regency. This is really nice. So the Metromover drops you right off in the lobby of the hotel. Wow. It is beautiful in here. And for some reason, it smells really good too. The Riverwalk Cafe. Yeah, Fred X has climbed that. So there was a good article in Barron's. Hyatt Regency Miami History and Milestones. Oh, this is cool. Huh. Interesting. So I'll sort of explain it again, because I think it's a great question. And many people pointed to the Bank of England. So we discussed this a couple live streams ago, but the Bank of England was very, very steadfast with quantitative tightening. Extremely steadfast on quantitative tightening. But they just recently pivoted to quantitative easing and started to buy bonds, or gilts is what they're called over there, because the credit market locked up and the currency started to decline extremely rapidly. And the reason for that is because they decided during a time of unprecedented high inflation, it would be a smart move to issue tax cuts. We won't debate that, but so the point is, the Bank of England didn't want to pivot, but they were forced to, or else the entire financial system would have come crumbling down. So in this Barron's article, it sort of compares the same situation. Fed Chairman Jerome Powell at the Federal Reserve is also very steadfast with raising rates. But could something like what happened in the bank to the Bank of England happen to the Federal Reserve? Now, I don't think so, and here's my opinion. But again, this is just my opinion, and my opinion doesn't mean much. The difference here between the Bank of England and the Federal Reserve here in the United States is that the United States is very lucky to have an extremely strong currency, or the Dixie, right? So we are essentially, our gain is pretty much crippling the rest of the world. And as the Federal Reserve raises interest rates, that makes the US dollar stronger, which degrades or devalues a lot of other foreign currencies. So in order for those countries and those central banks to protect their own currencies, they have to raise rates. So it's almost like a perpetual cycle. So I don't think the Fed will be forced to pivot in a way, but there's a very smart bond fund manager on Wall Street that was interviewed in this Barron's article over the weekend. And he said there's a particular level, we got the bridge going up again. There's a particular level where the Fed may be forced to pivot. And he says that is right around a 4.5% 10-year US Treasury yield, which is very far off. Because right now, the 10-year US Treasury yield actually came down substantially today. I think we're trading at 3.67%. I think on the 10-year, 3.6. Yeah, Fred pivot. There we go, Fred X. All right, I want some guesses in the chat. Do you guys think this is going to be a massive yacht coming across this? Or do you think we're going to get disappointed and get just like a very small little fishing boat or something? Oh, it is a massive one. Nice. Not too bad. That one was pretty cool. No way. Is that true, BMST Group? Is that really Ben Mala? I actually have a good story about Ben Mala. I can't tell you guys tonight, though. I'll tell you guys on another stream. Yeah, Dusty Coles is super cheesy music. Definitely not a good. Worst music, yeah. I would be playing some like Frank Sinatra. Well, then again, I'm not a big boat kind of guy. Ethan Horse's Ben is great. Yeah, he's got a good personality. I got a good story for you guys on Ben. But we just don't have time for it tonight. I don't know why, but I always love watching this thing close. This thing is insane. Yeah, Jacob's like, yeah, if you had that kind of cash, you might. That's true. Touche on that. Borat says, I want to skate that. I kind of do as well. Ooh, War Walker, thank you so much. I gotta run, guys. It's almost 11. What time is it? Do we know the exact time? Because I gotta make sure I gotta get the bus. But in conclusion, team, today was Monday. Big day on Wall Street. We got some extremely important economic news. So on the first business day of every single month, we have the Institute for Supply Management reporting their PMI numbers. We decelerated again. So we did a deep dive into that tonight. We also talked about some technical levels where this market may rally to. And I will see you guys tomorrow, 8:30 Eastern time. If you enjoyed tonight's live stream, feel free to hit the subscribe button. Also, leave a like button on the video. We'd love to see you guys back here for additional live streams. And I also want to say thank you, because I think we just recently surpassed 21,000 subscribers to the channel. Never in a trillion years did I think this channel would grow that big, and I have a blast doing it. I look forward to talking to all of you guys and girls every single night. I learn a lot. I appreciate you guys. I value your input. But that is all the time we have for tonight. So I hope you enjoyed this episode of Walks on Wall Street. We'll be back tomorrow, 8:30. And to the mighty bull, have a good night wherever you are, because there is always a bull market somewhere. You just need to know where to look. If you enjoy the kind of topics we talk about on the stream, if you scan the QR code on the top right-hand corner of your screen, I write a free investing newsletter where I share all of my thoughts on the US equity market, emerging markets, fixed income, all that good stuff. So go ahead, scan it, punch in your email, and you'll be signed up to receive that for free. It's a good way to stay in touch and support the channel. So Juan Carlos, thank you so much. Arsenal Fan 13, Siva, thank you. Joan, Deep Value Alex, have a good night. Lena Sandoval, thank you so much. Ryan Royal, Joan, The Investigator, I appreciate it. Hopefully you had a fantastic one. Photos from around New York, thank you for being a great moderator. Dusty Cole, Business Mail, the one and only, the man, the myth, the legend, the War Walker, Disney Hatch, Prototype, Rachel Abreu, Jacob, thank you so much for being here. Blues Writer, Mike C, Gregory, Brad's Brain, everybody else, appreciate it. ABX Girl, I could read your names all night. Shadow Shock, Shadowstock, Sabrina Fair. Take it easy, everybody. We'll see you tomorrow. We may be somewhere else. I'll leave you up with that.